An oil shock slammed markets, inflation fears came roaring back, and yields put the Fed right back in the spotlight. In this recap, we break down the March 9 through 13 sell-off, the brief CPI relief, the trade surprise, the growth scare, and why SPY, QQQ, crude, yields, and Nvidia now set up a critical Fed week. Welcome back to the weekly market recap. We are starting with the story that hit everything at once. On March 9th, a fresh escalation in the Iran war slammed into global markets through one channel. Investors understand immediately: oil. Crude shot toward $120 a barrel at the session high, Brent pushed back above $100 for the first time since 2022, and U.S. crude also cleared 100 before prices swung sharply later in the day. The trigger was a new wave of attacks tied to Gulf energy and transport infrastructure, plus renewed fear around the Strait of Hormuz, a choke point for a huge share of global oil flows. In a matter of hours, investors had to price higher fuel costs, hotter inflation, and a tougher backdrop for central banks. The shock spread fast across assets. In Asia, Japan's Nikkei 225 dropped more than 5% in early trading as the first wave of risk aversion hit equities. U.S. stock futures also tumbled, with S&P 500, Nasdaq, and Dow futures down more than 1% after being more than 2% lower late Sunday. Bonds did not offer the usual clean shelter because this looked like a stagflation hit, meaning weaker growth mixed with higher inflation pressure. The U.S. 10-year Treasury yield rose more than 7 basis points at one stage, and bond markets across Europe and Asia were pressured too. Energy and defense stocks outperformed, while rate-sensitive and import-dependent sectors fell behind. Then came the twist. In the United States, the session turned into a violent reversal after President Donald Trump made comments that raised hopes the conflict might prove shorter than feared, and after crude pulled back from its intraday peak. But that rebound did not erase the bigger message. Markets were no longer dealing with a small geopolitical premium. They were dealing with a live supply shock big enough to reshape inflation expectations, growth assumptions, and the expected path for Fed easing into the next week. That is why this was the #1 market driver of the week. Oil, inflation fears, bond yields, and global risk appetite all fused into one story on March 9th. Even after the intraday reversal, investors were left with higher fuel risk, a shakier soft landing outlook, and a more complicated policy picture. Next up, the CPI report offered a brief moment of relief. After the oil shock came a small exhale. On March 11th, the February CPI report showed inflation had not reignited before energy prices surged in March. Headline CPI rose 0.3% from January after a 0.2% increase the month before, and the year-over-year rate held at 2.4%. Core CPI, which strips out food and energy, rose 0.2% after 0.3% in January, with the annual core rate steady at 2.5%. That was close to expectations, and it told investors the underlying inflation trend was not getting worse just before the geopolitical shock hit commodities. The details mattered. Shelter rose 0.2% on the month, and rent increased just 0.1%, the smallest monthly gain since January 2021. Energy rose 0.6% after falling 1.5% in January, while gasoline was up 0.8% on a seasonally adjusted basis. Food prices stayed firm, with the food index up 3.1% from a year earlier and food away from home up 3.9%. Medical care rose 0.5%, apparel climbed 1.3%, and airline fares increased 1.4%. Used cars and trucks fell 0.4%, giving markets another sign that some price pressure was still easing. That is why the market reaction was relief, but only relief in moderation. The report did not validate the most hawkish inflation fears at exactly the moment traders were already dealing with higher oil and a harder policy backdrop. Rates eased some immediate pressure, and the data supported the view that domestic disinflation was still alive. But investors also knew this report described February, not the full inflation effect of the March energy shock. So this was a helpful number, not a final answer. It cooled the mood for a moment, but it did not overturn the week's bigger story about oil, yields, and stagflation risk. Next, attention shifted to the trade data. After the CPI pause, one cleaner macro surprise arrived on March 12th. The United States reported a much smaller January trade deficit, giving markets a rare upbeat data point in an anxious week. The goods and services gap narrowed to $54.5 billion from a revised $72.9 billion in December. That was a drop of $18.4 billion, or 25.3%. Exports climbed to $301 billion, while imports slipped to $306.6 billion. In simple terms, the country sold more abroad and bought a bit less from overseas, which helped the near-term growth math look better. The improvement was broad enough to matter. The goods deficit narrowed by $17.5 billion to $81.8 billion, and the services surplus increased by $1.0 billion to $27.3 billion. Compared with January 2025, the total deficit was down $73.9 billion, or 57.6%. Exports were up 28.4 billion from a year earlier, while imports were down 45.5 billion. That said, the 3-month average deficit still rose to $61.1 billion, so this report improved the latest monthly pulse without fully erasing the choppier backdrop underneath trade flows. For markets, the key point was mechanical but important. A smaller trade gap can lift GDP tracking because net exports subtract less from growth. That softened the idea that the U.S. economy was weakening on every front just as oil and inflation worries were building. It did not flip the broader mood, but it gave investors one real counterweight to the more negative growth headlines. So this was a useful bright spot, not a full mood changer. Trade looked better, recession anxiety eased a little, and then attention moved to the next problem, weaker growth and sticky inflation together. The final item of the week was a macro pileup. On March 13th, investors got weaker growth, sticky inflation, and softer confidence all at once. Fourth quarter 2025 GDP was revised down to a 0.7% annualized pace from 1.4% after 4.4% growth in the third quarter. Real final sales to private domestic purchasers were cut to 1.9% from 2.4%. That told markets the economy entered 2026 with less momentum than previously thought. Inflation, meanwhile, was not weak enough to calm anyone. The monthly PCE price index rose 0.3% in January after 0.4% in December, while the year-over-year rate eased only to 2.8% from 2.9%. Core PCE rose 0.4% on the month and 3.1% from a year earlier. Real consumer spending increased just 0.1% for a second straight month, so households were still spending, but inflation-adjusted demand looked soft and the Fed still had a sticky core problem. The labor and confidence side added to the uneasy mix. January job openings were 6.9 million, hires were 5.3 million, and total separations were 5.1 million. Consumer sentiment slipped to 55.5 in March from 56.6 in February. One-year inflation expectations rose to 3.4%, and long-run expectations were 3.2%. That looked like a cooling economy, but not a clean disinflation story. That was the real message. Growth was softer, core inflation was still hot, and the soft landing story looked more fragile. It was not the biggest market driver of the week, but it summed up the stagflation anxiety underneath everything else. We start with SPY because the S&P 500 is the cleanest read on the market's mood this week. This chart shows sellers still in control into the close, with price finishing near the bottom of the daily range instead of attracting a confident late rebound. That is exactly what a fragile tape looks like when traders are weighing softer growth against inflation risk that still will not fully go away. If the oil shock from early in the week keeps feeding cost pressure, this kind of weak close tells you investors are still quick to de-risk first and ask questions later. The next chart shows just how stretched that move became. SPY is trading outside the lower Bollinger Band for a second straight session, which is a classic sign of extreme short-term weakness, even if that condition does not usually persist for long. In plain English, the broad market is not just drifting lower, it is pressing into a zone where fear and forced selling have clearly picked up. The CPI relief in the middle of the week helped sentiment briefly, but this chart says the downside pressure still dominated the bigger weekly tone. Zooming out, the bigger structure still matters. The S&P 500 remains in a golden cross setup, with the 50 days average above the 200 days. So this is still a pressured pullback inside a longer-term uptrend rather than a confirmed long-term breakdown. But the warning is clear too. The 50 days has already rolled over, and price is moving closer to the 200 days, which turns that area into the next major support test if weakness continues. So SPY sets the risk tone first, and from here the natural question is whether QQQ can hold leadership or whether tech starts to crack with it. After SPY set the broad risk tone, QQQ shows where leadership is getting tested. The Nasdaq 100 is sitting in a live squeeze, which means volatility is compressed even as momentum leans bearish. Price is still above the 200-day average, but the 50-day average is overhead and acting as the next resistance zone. That leaves big tech caught between long-term support and near-term pressure, which is exactly the kind of setup that can break hard once the market picks a direction. If the oil shock keeps inflation fears elevated, this tight setup can resolve lower much faster than it looks. The short-term picture looks more fragile here. QQQ is trading below the falling channel, and the lower boundary just acted as resistance again instead of letting price move back into structure. In plain language, rebounds are still being sold, and that keeps the burden of proof on the bulls. If rates and energy stay jumpy, this failed reclaim keeps downside pressure on the highest multiple part of the market. Zooming out, the bigger trend has not fully broken, but it is clearly under stress. QQQ is still in a golden cross structure with the 50-day above the 200-day, yet the 50-day has already turned lower and price is moving closer to that longer-term support zone. So the Nasdaq is still a pressured pullback inside a longer uptrend, not a confirmed long-term breakdown. And that is the key handoff into crude, because if oil keeps driving inflation worries higher, this support test gets even more important for tech leadership. After QQQ showed leadership under pressure, crude is where the macro shock becomes impossible to ignore. This chart shows ATR at the top percentile of the past year, which means daily price swings in front-month crude are now extreme. In plain language, oil is not just grinding higher. It is repricing fast enough to hit inflation expectations, risk appetite, and sector leadership all at once. If the geopolitical supply story keeps markets on edge, this kind of volatility can keep feeding a much tougher backdrop for stocks and for policy expectations. The next chart shows why this move matters beyond one headline spike. Crude is trading in the upper part of an expanding structure, momentum is bullish, and price is sitting just below resistance near 103. That tells you buyers still have control, but the next confirmation is either a clean breakout or a rejection from this upper zone. If energy stays bid, the inflation story gets harder for the broader market to dismiss. Zooming out, the bigger message is that crude is no longer just bouncing inside a weak long-term trend. This chart shows an early-stage golden cross, with the 50-day now above the 200-day, which points to a possible longer trend shift higher even though the move is still young. That matters because a more durable rise in oil can keep pressure on inflation and complicate the soft landing story. And that is the right bridge into 10-year yields, because once crude resets inflation risk, the bond market has to decide how much of that pressure to price next. After crude reset the inflation debate, the 10-year yield shows how the bond market is responding. This chart puts TNX above its rising trend channel for a second straight session, with the upper band now acting as support instead of resistance. Momentum is improving, RSI is rising, and the move is holding in breakout mode rather than fading back into the range. In plain language, rates are pushing higher in a way that keeps pressure on equity multiples and on the idea of easy Fed relief. If oil stays firm and inflation worries keep building, this breakout structure says yields can remain a real headwind for stocks. The next chart shows just how aggressive this move has become. TNX is closing outside the upper Bollinger Band for a third straight session, which signals extreme short-term strength even if that kind of stretch is not usually sustainable for long. So the message is not that yields have to rise in a straight line from here, but that the bond market is repricing fast and forcefully. If the macro story stays stuck between softer growth and sticky inflation, that kind of rates pressure keeps the Fed front and center. Zooming out, the bigger picture is where the policy tension really shows up. TNX is still technically in a death cross, with the 50-day below the 200-day, but prices move back above the 200-day average and puts that older bear structure under real strain. That means the longer trend in yields has not fully flipped yet, but the odds of a broader reversal are clearly rising. And that is the perfect handoff into Nvidia, because when long rates stop falling cleanly, the market has to see whether AI leadership can still carry tech sentiment. After yields kept the rate debate alive, Nvidia is where the market checks whether AI leadership can still absorb that pressure. This chart shows sellers controlling the close, with NVDA finishing in the lower part of its daily range and even in the lower 5% of that session range. That is a weak ending signal because it tells you buyers did not take back control late in the day. Compared with last week, the stock still looks like leadership under pressure rather than leadership fully broken. If rates stay firm and macro stress keeps building, that kind of close can keep sentiment fragile across the whole Nasdaq complex. The tactical picture gets more important here. NVDA is trading below its rising trend channel. The lower band rejected the latest rebound, and the first reclaim level sits near 180.80, while RSI is down at 44 and falling. In plain language, rebounds are still running into resistance instead of turning into clean recoveries. If the broader market keeps wrestling with oil-driven inflation risk and sticky yields, that failed re-entry keeps downside pressure in play for one of the most important leadership stocks on the board. Zooming out, the longer-term structure is still the key reality check. Nvidia remains in a golden cross, with the 50 days above the 200 days for 179 days, and both moving averages are still rising even though price is now below the 50 days line. That keeps the current move in correction territory inside an intact longer-term uptrend, not a confirmed long-term reversal. And that is the right bridge into the economic calendar, because the next macro data run will help decide whether leadership stabilizes from here or faces another round of pressure. To close the week, the calendar shows where the next round of macro risk is concentrated. Wednesday, March 18th brings a full cluster of high-impact events, starting with U.S. Producer Price Index ex food and energy year over year, then the Fed interest rate decision, the monetary policy statement, the FOMC economic projections, and the press conference. The image also flags Saturday, March 21st for a Fed Chair Powell speech, so policy communication stays active even after decision day. In plain language, the market is heading from an oil shock, sticky inflation worries, and rate pressure straight into the part of the calendar that can reset the entire narrative. If the Fed signals more caution than investors want, yields and risk assets can stay under pressure. But if the message sounds more balanced, the market gets a chance to stabilize after a very tense week. That is the real takeaway from March 9th through 13th. The market is caught between softer growth signals and renewed inflation pressure after the oil shock, while yields stay active and tech leadership looks pressured but not fully broken. So the bigger uptrends are still trying to hold, but the room for error is clearly smaller now. If next week's macro data and Fed signals come in steady, markets can stabilize. But if inflation risk keeps building, this correction can stay uncomfortable. Thanks for watching. That was your weekly market recap for March 9th through 13th. Stay sharp, manage the risk, and I will see you in the next one.